tous nos remerciements à Monsieur Jacques de la Rosière d'avoir partagé.
Thank you very much, Mr. de la Rosière, for sharing these very enlightening insights. And without further ado, I suggest we start the second panel session on the topic of how to operate in such a volatile world. I would ask Jean-Laurent, Granier, Michaela, Koller, Sonja, Rottiers, Martin, Merlin, and Natacha, Valla, in her capacity as moderator for this panel, to please come to the stage. Thank you very much. Good morning and welcome to this first panel session in this conference. After a very enlightening talk, dear Jacques, I was very sensitive to it on the monetary policies. Now the topic for our panel session is how to operate in an environment where the degree of volatility has increased, volatility related with a number of factors which are specific to our times. We have volatility connected with the uncertainty of the major geopolitical aspects and economic policy, the trade war, of course, Brexit, of course, and more generally speaking, the global geopolitical aspects and the climate risks, of course, climate change risks, which have gained more traction in the financial industry, and of course the development and advent of new technology as is being experienced and as it is impacting the world over, and including the insurance industry. So it is my great pleasure to moderate a very high-level panel session. Martin Merlin, who is the Director for Banking and Insuring with DG Fisma at the European Commission. Michaela Koller is General Director of Insurance Europe, and we do have a gender balance, which is quite rare, so it needs to be said. Sonja Rottiers, sorry if I mispronounce your name, CEO of Lloyd's. I intentionally started in French. I hope it's okay. And then we have Jean-Laurent Granier, who is the CEO of Generali in France. So welcome to you all. Now, before I introduce the scene, I was asked to come up with an animated introduction, which will be a good transition after Jacques' talk, because all the slides you wanted to show, Jacques, I will display them now on the screen, which shows how open we are at the central bank level. And I think these slides will illustrate the fact that there is a great diversity in the views, in the viewpoints and analysis by central bankers, and that the final results in their monetary policies are basically a question of trade-offs, compromise, convergence. So let me take a couple of minutes to do that with a couple of slides, starting with the key facts and numbers which Jacques mentioned, and basically with respect to the trends in interest rates, especially long-term trends related with inflation rates, the real factor connected with the trends in long-term interest rates. Now, number one argument is that the interest rates are extremely low, as was said. You have here a breakdown of the low interest rate environment due, as you said, Jacques, to the Eurozone economic policy. This is in color blue. The US economic policy, this is in color green, and some risk factors factored in this landscape in color purple, with a minor impact. Second, the major phenomenon with respect to interest rates is that the long-term rates, risk-free interest rates going down. You have here the trend in long-term rates in the US compared with the Eurozone. This decline in long-term interest rates are more related to the squeezing out of the term yield curve. So the term yield is in color blue, and projections of interest rates in color green. So with respect to what Jacques said about the credit spread, it's been a an intentional policy by the central banks to press the yield curve on the long-term side. Now, with respect to the trends in the equity stock prices, and you have here the trends from mid-2018 onwards. And if you look into the detailed factors which have impacted the equity prices, you have from top to bottom positive factors which were offset by negative factors. The most positive contributive factor in color yellow was the discount rate. So low interest rates have been contributing to maintaining momentum and buoyant equity price markets. The second contributive factor was the dividend payout policy. Stock buying programs of a lesser extent in Europe versus the US, but it's a factor which has been contributing to the situation. And conversely, the risk premiums, the risk premia on equities, and the future return prospects have come to play a negative contribution in this situation. Now, you also have mentioned that there were long-term factors due to what you might call circular stagnation and some demographic factors. And when you break down the headline inflation between the two factors, you have the real rate, which stands at a very low level today, and you have also some trend-related adjustment downwards of the inflation projections as they are measured on the market. So much for the current situation. And indeed, you have the structural long-term factor which has been impacting the so-called R-star, the actual equilibrium rate, but the monetary policy is aimed at lowering and plateauing the yield curve today, announcing that it would do so for a number of years. We want to engage in some thinking process, and the Europeans have to do it. It's already engaged in the US on the equilibrium level of actual long-term interest rates, and as correlated to that, a thinking process on the monetary strategies and on the target inflation rates. And with respect to the stance measures, it's behind us, but with respect to the review and revision of monetary policy, this work still has to be done, and the ECB will have to engage in this process in as open a manner as possible, including academics and analysts and market practitioners. Now, what about the market situation, the economic situation, which I mentioned initially today? The economic situation is cyclical, at a cyclical point where there's been a global slowdown of the economy, with a number of risks connected with Brexit, with the trade war. And when you dig deeper into the analysis with respect to the real economy, and this is what the PMI indicators, manufacturing index and manufacturing output indices, these indices are downward, mainly due to the decline in the manufacturing industry, with the services industry holding firmer, with some transfers from the manufacturing industry to the services industry, but quite at a marginal level. So I'll probably stop here. Last point on how these financial factors, these key major financial issues with the funding, the financing of the real economy and the corporations. Far left here, you have a slide illustrating the external financing of non-financial corporations in Eurozone. You have the gross flows in billions of euros, and the breakdown of these funding flows, of these financing flows, shows that there is a high proportion of debt, mainly banking debt in the picture, some bond issues for those who can, who are able to do that, for those who have access to sufficiently liquid and deep markets, which is the case for the French and Europeans. No equities, no equity issues. So here you have a question with respect to the structuring of the external financing for the corporates, which possibly possibly will have issues with respect to the sustainability of the growth model. And to pick up on what Jacques said, we're seeing new investors in equity or equity-like instruments. For example, the number of insurers who have taken an interest in the central bank analysis and positions, even though the banks are the primary factor for transferring and conducting monetary policies, because we've engaged in lots of quantitative easing and equity measures due to the net purchases that will be reactivating next week with our new chair coming at the helm. We are aware that there's been a shortage on the risk-free bonds, and the insurance companies and their balance sheets are extremely exposed to the valuation of these securities. So more and more, we're digging deeper into the analysis. What is of greater interest for us is to see how investors via investment funds, and the French insurance companies are advocates of investment funds, how these insurance companies keep getting exposed to equities, to equity investments. This is something you might talk to us about. What's true is that external financing of corporations is still mainly via debt, and you can see this on the right-hand side, where the relative cost of external financing is showed here, with the highest cost level on the red curve, which is the cost of equity, which is largely higher than the average cost of financing, which is a light blue curve, and even more than the cost of refinancing by way of debt or by way of the banking loan. So I will be the timekeeper here, and I will stop here, if I may, and I will give the floor to the panelists. Martin, Merlin, turning to you.
About regulation issues in the insurance sector today. Well, we're gradually moving to the insurance sector in our discussion. There are a certain number of factors that generate volatility on the balance sheet of insurance companies. I would mention interest rates. We note that interest rates on French government bonds are negative now, up to a maturity of 16 years, which has a significant impact potentially on life insurance companies' solvency, based on pressure put on future profits for these companies, and also with increased vulnerability, exposing these companies in cases where interest rates were to drop more. That's my first point. Secondly, there is the situation on the equity market with many uncertainties linked to international trade tensions, linked to Brexit, and we cannot set aside the risk of a market turnaround with a flight to quality that may have serious impacts in terms of financial stability. As you know, we must review the regulatory framework that applies to the insurance sector between now and the end of 2020. We are supposed to make legislative proposals to enhance the framework. We shall therefore seek to take into account volatility factors when reviewing Solvency II. Let me point out a few issues in this respect. First of all, we have the review of long-term guarantee measures. We'd like to examine, in particular, volatility adjustments to make sure that the rules in Solvency II in this field do make it possible to properly manage the risk of short-term volatility and the impact that this may have on solvency ratios. We know that volatility adjustment, well, there are different views on the matter, and in the coming months, a lot of work must be done so as to determine whether or not we should review the rules that apply to volatility adjustments. When reviewing Solvency II, we also shall try to examine the risk of interest rates. We must admit that the current framework does not reflect the realities that we see, where we see negative interest rates. And this may have a significant impact on protection policyholders. We must look into this, and in particular, we must carry out quantitative studies that must be as robust as possible. And next, we have the risk margin, which is obviously closely tied in with interest rates. Here we called upon EIOPA to carry out an overall assessment of the rules that apply to risk margin, and therefore the contribution of insurance companies will be particularly important so that we can have the best possible data. Furthermore, we must examine long-term investments. Of course, many market players tell us that using market value raises a problem, and that calculating capital requirements with a one-year horizon also is problematic. We do take note of these concerns expressed. Having said that, we must admit that the drop in equity investments is a trend that dates back to the 90s. So it cannot be said that Solvency II is the only instrument responsible. This framework was only introduced just a few years ago. So there's a major trend afoot here, but this is something that we must look into. We have already amended the framework of Solvency II to facilitate long-term investments, especially in infrastructure projects and in certain equity instruments. We will examine how these new rules operate and what impact they have. And of course, we are ready to discuss about the possibility of going further. Since I have the floor, let me briefly mention two important points for the new commission that should start in a few weeks' time. First of all, we have the climate risk that you mentioned, Natacha, and also green financing. Clearly, this is an area where insurance companies may play a decisive role. First of all, by better taking on board sustainability in financial advice and in risk management practices. We hope in the near future we'll have a legislative agreement on a taxonomy so as to identify what is green or not. We also hope to soon complete our work on a European standard for green bonds. So these are topics that where we hope to have an active contribution by the insurance sector to help us to make our economy greener. A second point that I would like to mention, which is also a priority for the new commission, here I'm referring to digitization and the gradual changeover to the big data economy. Here, of course, we must expect more competition in insurance. So it will be important for insurance companies to review their business models and how they operate, and also how they organize contracts. It will be very important for the Commission as well. We will try to set up a regulatory framework that can promote innovation while being very vigilant regarding cyber risks, which may require drawing up a European-wide regulatory framework to increase the level of security in this respect in all countries in the European Union. Thank you so much for that broad panorama.
Industry's perspective, and given your background, how would you link those EC priorities into what kind of challenges you're facing? Are these challenges, are these opportunities for you?
Thank you very much. I was kind of hoping that Martin will pave the way for me, and he did. I thought really I look at the new Commission and the ambitions that the new Commission President Ursula von der Leyen has formulated. She has 6 headline ambitions, and when you look at these 6 headline ambitions, 4 of them are such that the insurance sector sees challenges but also opportunities, and where we can see a link, where we can really contribute to the Commission's agenda. Now I start with the first one, and that is a stronger Europe in the world. Now when you look at this, the first thing we did is we checked what happened when the Juncker Commission took office. What was our situation then? And when you look at this, at the time 5 years ago, the European insurance sector was the biggest regional sector by premium in the world. We look now 5 years later, we were trailed by North America, but with a huge distance, and then Asia. 5 years later, Asia is the biggest insurance sector in the world. They have gained massively. North America has gained, not as much, but still gained, and Europe has shrunk. Now, of course, Asia also gains because of the size of population, very clear, but we have been looking to what extent does regulation make a difference. And we know Solvency II, is the most sophisticated framework in the world, and it's aspired as the key framework, I think, by many supervisors around the world. But when we talk, for example, last year we had discussions with the Chinese supervisors, not the industry, or the Japanese supervisors, and they tell us, we like Solvency II, we want to copy it, but we take the good bits, because we don't want to punish our industry, and we don't want to kill our pension sector or our long-term industry.
What are the good bits of the world?
Well, let's come to that in a moment. And there are lots of good bits, because as the European insurance sector, we are very supportive of Solvency II. I think it's very important to state that. When you look to Northern America, again, they have really massively gained. And there we know from the supervisory system that they say we reject Solvency II, but they reject it for the same reasons as others say we only take the good bits. Again, the treatment of long-term business. Now, our challenge is, and there is also a difference when you look at how are supervisors looking at their job. The Chinese, the Japanese, the American supervisors tell us we have to have growth and competition also in the back of our mind. It's certainly not the only consideration, but it is one consideration. In Europe, you speak to the supervisory community, you never get this. Is it good, is it bad? It's at least something we would like to discuss. So for us, the 2020 review is a challenge, but it's also an opportunity, and we would hope that the treatment of long-term will be discussed, and not just upwards, but really, in terms of a release of capital, because we are deeply convinced that would be justified. I come to the second key ambition that Ursula von der Leyen has formulated, and that is the European Green Deal. And I think it's fair to say that insurers play a key role in that in 2 ways. Because on the one hand side, we are of course investors, and then we are also underwriters of climate risk. Now let me first look at the investment side. We know that we need to have 180 billion euros investment per year if we want to meet our climate targets. In 2018, the European insurance sector contributed roughly 50 billion. So there is already a strong engagement of our sector. Where are our problems? The first problem is, I think it's important to say we are not a sector that says we need a green factor, you know, that is more favorable. Quite the contrary, we are happy with the Solvency II risk-based approach. We want to keep it. We want neither a brown punishing nor a green preferential factor. We think it should be risk-based. But where are our problems? Twofold. First, there are not enough assets to invest in. If we have you know, bond issuance, they are largely oversubscribed, and there is an issue. And then second, the second problem we have, most of the sustainable assets are, again, long-term, and again, we go back to the long-term treatment. So again, Solvency II, review, it's a challenge for us, but also an opportunity. Sustainable underwriting, also interesting. We are under huge public pressure to withdraw cover from, you know, traditional energy providers. You know, unfriend coal, we have massive pressure. But then when you look at it in Europe, which is the most advanced region in the world, we have not a single member state that can cover its energy consumption by completely exclusively renewable energies. So we have obviously still a part, I look at Poland, I look at other countries, where you have to still provide cover also and underwrite risks for these kind of providers. But what we as an industry can provide is stewardship, and what we are looking for is really a coalition of many partners, not just pressure on the insurance sector, that we can go this path to the transition that we are all very supportive for. I go to the third headline ambition, where we think we have a key role to play. Ursula von der Leyen has said she wants an economy that works for the people. Now, when you want an economy that works for the people, you look at pension as a first issue. We have a 2 trillion additional saving requirement if we want to close the pension gap that we currently have. And again, you know, the insurance sector can play a positive role in that, because what we have seen in the last 5 years is basically a shift to unit-linked. And what do? We put the risk on the shoulders of the individual. This industry can still take risk. Of course, we have adapted. We are in a low interest rate environment. We know that. We have adapted our investment policies. We have adapted very clearly also our products, but we can still provide meaningful guarantee and protection. But again, you know, we need the right treatment for our products and not one that exaggerates the volatility. So I always come back to the chance that we see in the Solvency II review. I cannot talk about an economy that works for people without also mentioning PRIPS. And I'm sorry for that. Maybe it's a bit of a different context. But you know, when you speak about volatility, you need to speak about volatility overall. Yeah? And while, as I said, in solvency, we are looking largely for stability and only, you know, adaptation in the long-term area and maybe proportionality, here when it comes to PRIPS, we are asking for stability. Why? Because when you look at PRIPS, it's a disaster. We cannot inform our consumers in the right way. We have regulation-induced misinformation. That is where we currently are. In the worst case, we have to tell our clients that they will earn 300% in a product, which clearly they don't. But that's the methodology. So we have this issue, but then we have as provider the additional issue that we run through all these changes, and I need to go back, although I lived through them. So since it was adopted, we had one quick fix, then obviously the level 2 RTSs, then an EC communication. We had a series of 5 questions and answers, and then we had an ESA supervisory statements, 8 clarifications in a period of 2 years, and now we will have a quick fix. And we are super grateful to the Commission that you have now said we want to do a study, we want to analyze this, and we want to do the review when it is actually foreseen by regulation in 2 years' time, but please stop changing interim, because it really is only giving costs to us. It's not improving the situation for the consumers, because all the proposals we see on the table don't work and don't improve. My last point, sorry, is Europe fit for the digital age, as also mentioned by Martin. And there we have 2 issues. We have the issue of connected cars, automated cars, and then we have the issue of cyber. I'm very brief now. On the issue of connected cars, when you look at it, it's quite interesting on how Europe deals with data. And again, I make a global comparison. When you look at China, data is owned by the state. When you look at the US, data is owned by the GAFAs, by the big companies. In Europe, we have decided data should be owned by consumers. And that's the right decision, and we really also believe that should be the case. But it is not the case in Europe, because when you look to connected and automated driving, who owns the data? It's the car manufacturers. And there is no way that a consumer can decide who he gives access to. It's because the car manufacturers have created facts, technical facts. For the last 5 years, we have discussed with the Commission in 4 different DGs, and we have so many studies that now prove that that is the fact, and we still don't see the changes. So again, what is our challenge now? To convince the next Commission to really make sure that the consumers can decide with whom they share the data, and then we as insurers are ready to compete with everybody else there. But we do not think that car manufacturers should have an advantage. And my last point is cyber. So we have a cyber market, 85% is in the US, 8% is in Europe, roughly 7 of it in the UK. So after Brexit, we are left with relatively little. What is the difference? Why is the US so strong? There are 2 reasons. There is a notification duty to collect cyber breach data, and then there is a possibility for the insurance sector to get this data in an aggregated and anonymized way. In Europe, we have made the first step with the GDPR and the NIS directive. The data is now collected, but it's not yet shared with the industry. That's the next step. And we are not asking for individual data, we are asking for anonymized aggregate data. In Insurance Europe, 3 years ago, we have developed a data breach template for notification. We are working since then also with the Commission to get traction. We are super grateful to IOPA for also now saying this is an important thing. We need to bring up the cyber market, because cyber risk is not just the risk we are exposed to. Cyber is also something where this industry can play a meaningful and positive role. So in summary, when I look at the next Commission, I hope that in 5 years' time I can sit here and say we have seen a Solvency II review that has allowed us really to come back in terms of global competitiveness, to really make a meaningful contribution on sustainable finance, to help pensioners. And I hope I can also come back and say we have stopped on conduct of business, this trial and error approach, and on cyber and automated cars, we have made the right decisions. And sorry for being maybe a bit long, but you wanted to get a complete picture of the challenges. They are huge.
And you made the bridge. So maybe later you might want to address some of the specific issues that were raised. But thank you for making the link to, European energy policy, green policy, and also digital policy. I now turn to you for the obvious question, really, where you come from. Brexit, what does it mean for you, and whether digitalization can be helping in the transition?
Brexit n'est pas le seul changement fondamental.
It's not the only fundamental change. It's very difficult to isolate it because the world was faced with fundamental changes ever since 2008. Therefore, the financial stability and the protection of consumers being quite rightly the main concern of regulators. So we have an increasingly detailed regulation like the GDPR, or, for example, proposing to change regulations as regards solvency. So globalization has always seen by most people or economists as a benefit, and therefore the insurance world and globalization means spreading risks, and therefore coverage costs more favorable. And so efforts have been made and are being made within IAS to put together regulations in order to have harmonized global matters. So the Brexit will certainly change the relations. There are some players who acted very swiftly, so they are prepared, bearing in mind that there are some uncertainties that prevail regarding future relations between the UK and the European Union, especially about the way the British financial sector can remain a key player in continental Europe. Clearly, there are some costs and challenges which are associated, and recently read in Ian Wines said that the effect could be that there could be 7,000 people who could be transferred or offshored from London towards continental Europe. At the same time, we were talking about asset values that could represent 1,000 billion pounds and leave the UK. And however, if the UK leaves, and after a potential transition period, maybe the continental rules could apply to the UK. So it creates opportunities for the UK, and there are also some benefits that will disappear, such as the freedom of service and the customs union. So therefore, bearing in mind that financial institutions and intermediaries from the UK will be coming from a third-party third countries, and their access to the London market will not be obvious because the freedom of service will no longer be an option. In the meantime, the union indicated very clearly that it would comply of the standards of the union after the Brexit. For example, the EIOPA clearly identified the fact that we should be totally complying with the ITT standards. This position has an impact on the British insurance intermediaries. They will have to adapt. Not everyone has the resources to face higher costs related to the fact that going to a European entity. And for some, it will be a challenge. Some players will disappear. Others will seize this as an opportunity in order to grow in the European Union. With Solvency II, the Union succeeded in influencing the pace of globalization and especially its content. And the Brexit seems to put the brakes on this trend as regards of the European financial regulations on the global market. We don't know yet what are the specifics of the Brexit agreements, but politically at least it seems that the UK is no longer is looking at this, could choose to align its regulations on the principles that are in force, especially in the US. This could have consequences, major ones, on the global active insurers. There was a short-term question, which was to find out what about the existing contracts after the Brexit. Therefore, there are a large number of companies, such as Lloyd, which set business in Brussels in the interest of all European policyholders, and to offer them a secured contract with top-ranked service. What it matters very much is that each coin has different faces. Well, after the Brexit, there would be probably new prospects regarding the globalization of financial services by adjusting it to the current financial services. There would be new insights. It will be useful for the Union not only to discard these changes as outgrowth of the Brexit. On the contrary, I think it would be important that the Union review these new means and regulate the activities and make sure that take the good bits, but also draw the lessons for useful developments, even in the case of European financial and economic regulations.
Merci. Donc, pas complètement alarmiste, mais réaliste.
You're being quite realistic in terms of your vision of the Brexit. Jean-Laurent, now, let's get maybe an update on the major upheavals, on the way they influence the insurance business and this volatile environment.
Michaela, for the straight talk, notably vis-à-vis some compulsory needed evolution that we face regarding European regulation. Thank you for this.
Coming back now to the volatility issues and the upheavals that impact this sector, well, volatility is another way of characterizing the unexpected, which is our business as insurers, and that environment, as mentioned by our chair, offers us insurers new opportunities. However, we should really be able to assess properly such upheavals, because working with the unexpected entails the fact of working with the likelihoods or the probabilities that we may assign to certain events. And I believe that we all would agree that we are seeing that there are some major upheavals which are at play in three fields: demographically, the climate, and the economy. I mean, in the demography, the migratory pressure, the reversal in forces in terms of generations in societies with more and more questions about funding, pensions. We see this even in phenomena such as the yellow vests in France, and how to finance healthcare and social protection with cost inflation that technology enables, in a way, to update. Therefore, there's a major demographic upheaval, and the insurer, by definition, is a partner of society in that he helps to protect and helps to look at the long term. And so we're affected by it. When, in terms of the climate changes now, everyone has in mind now, well, certainly the significant disasters such as Katrina, 100 billion of damage, or Lota Mitra, 13 billion, might occur more frequently, and therefore these are not events taking place 2 or 3 times every century, but we are seeing mainly mushrooming events which are sudden, specifically located, quite unexpected, with level of damage that we need to take into account as insurer. Just a figure, 3.5 billion of damage on NatCat in 2018. There haven't been any such ones in 2018, but that's nearly twice the cost of a normal year of this kind of event. So added to these violent events come others, such as drought, damage to buildings, and the way we see these losses emerging. So this demographic and climatic change forces us, in terms of research and integration in our premiums, in our vision of occurrence probabilities, we need to change our landmarks. And there's an economic change, or sea change as well, even if there's a panel this afternoon dedicated to negative rates. I would like to mention a few things about this. As an insurer, we, by construction, we manage savings in life and P&C due to the production cycle. And we have included in the way we do our business the fact that we manage savings, the fact that we have assets, whilst today the bearings have been totally upset, and I believe that we are increasingly aware that we should not speak in this regard in a non-responsible way. There's a sea change in this in our economy, in our business model. Certainly we are happy to assert that insurers in general, especially the French ones, are very solid, and nothing is being challenged through this, these changes. However, in the way we carry out our job of being forward-looking or taking our obligations or managing savings, we need to take into account that field, especially since one of our mission is in a way to contribute to growth. There are 1,700 billion euros which are in life insurance, about 300 of it in unit accounts. Our calling would be to help grow through the investments we made, but what we see is that this negative rate phenomenon might lead, as was mentioned very powerfully by Mr. Lavoisier, there's a risk of deflation, which then would have knock-on effects on the economy. So how will the insurers react in regard to these challenges? One of the features of our trade is to be able to have obligations, commitment over the long term, even if our certainties change. I listened with interest the inflation so highly desired by central bankers. I was a student in the 80s, and I heard then at the time that the central banks wanted to kill the inflationary monster. However, they kept killing the already dead monster. They didn't see how the trend that was changing would be a problem for growth and for the unfolding of cycles. Due to this fact, our virtue, our main quality as insurer is to be able to have convictions that will be robust towards all these elements and that will allow, beside the models which are necessary but not sufficient, to have a vision over the long term maintained and set in this regard. What we can say and do today in terms of research and working on the integration of technological phenomena and the consequences coming from the numerous data we have available and the way we are directing our investment policy, it will be a way of taking up these challenges. And by the way, in this regard, today in the field of prevention and anticipation, we act as an educator due to this long-term vision in order to decipher in a way these phenomena for our clients through our networks and explain the new constraints which are emerging, and after that being able to translate this into product advice, investment, and products adjusted to the present situation, and how should we reinvent the savings model in France, especially to make it more productive, more company and economy focused, and more accepted by French savers who unfortunately have in mind the livret A, which is not very productive in terms of economic growth. Lastly, in terms of volatility and upheavals, it was mentioned, but I want to mention it as well. I mean, the regulatory upsets, the changes of bearings that may well, through their procyclicity of being an additional destabilizing factor, and in this regard, the way the IFRS 17 implementation is coming along, which is purely European in regard to insurance and non-life liability. It's very important in terms of the stability of the whole system that we don't have an upheaval through the loss of bearings that it would generate, would lead to decisions that would not be aligned with our ability to take long-term investments and commitments. Thank you. Very, very comprehensive point of view. Let's now move on with a discussion, maybe a bit freer before we open the floor. There are 3 points on which we can come back. First of all, regulation, and you can all express yourselves on this. Is regulation stability a response to this volatility, or should we make adjustments, and if yes, which ones, and what kind of balance should we strike between these two different approaches? Sir, over to you. You were not challenged, but when I share a panel with Michaela, there's a lot of work for me.
Three pertinent points in English. I will seek to respond in English. First, on the Solvency II review, I have to say that I sense very often a tension between the fact that people want consolidation in the field of insurance. People do not want to have a radical overhaul of the Solvency II framework, but at the same time, stakeholders list quite a number of topics that need to be addressed, and that could potentially actually lead to a very significant overhaul of the system. Now, I noted, Michaela, that this is not totally true for you, because you said that your priority was very much long-term investments and the treatment of the long-term business of insurance companies. So we take good note of that, and we are working hard on the matter with IOPA. At the same time, I have to say again that the data that we get on this subject is not that clear-cut, and the extent to which Solvency II is hampering long-term investments doesn't come out, you know, in a very clear manner from the data that we have. So we need to work harder on that to make sure that we can disentangle the Solvency II effects from other types of effects. And here, of course, it may seem limited, focusing on the long-term business of insurance companies and long-term investments, but the implications can be quite significant, because what is behind, of course, is the use of market consistent valuation, which is embedded into Solvency II. Do we want to put that into question? Then, if you do not want to put that into question, what can we do in order to facilitate long-term investments? Is it about, you know, fiddling with capital requirements? Maybe, but then we have to make sure that we do that in a prudentially sound manner, which is not something which is not that easy. Then there is the issue of pensions. You mentioned the pension gap. We have right now a high-level expert group set up by the Commission, which is working on the matter and which is due to make recommendations by the end of the year. But here as well, you know, there are various types of reforms that can be set up by the member states, which ultimately are responsible for their pension systems. Some of these reforms may give a greater role to supplementary pensions, others not. We do believe in the very useful contribution that supplementary pensions can make, and that is why the Commission has tabled a legislative proposal on personal European pension product, which has been approved by Council and Parliament, and which is now being rolled out. At the same time, here as well, you know, to a very large extent, the responsibility lies with the member states. If we look at the PEP, well, the PEP is not going to take off if member states do not put in place the necessary tax incentives so that it works. And here we still have to see that, you know, member states do what is needed in order for this product to take off so that it can be a positive contribution to address the pension gap. I will not dwell for too long on PRIPS. Just to say that PRIPS is probably a good illustration of the difficulty that we have in regulating within one framework very different types of providers, which actually compete on the market. So we need to aim at a single regulatory framework that makes sure that we have a level playing field for the different types of providers, whilst recognizing the different types of business models that they have and the different types of products that they put on the market. I hope that with PEP, we manage to find a better balance in this respect. PRIPS is probably an area where, you know, more work is needed, but I take your point that rather than constantly changing the framework, what is needed here is probably a pause and a general review of the PRIPS framework. Finally, on data portability, this is obviously a horizontal issue affecting many industries, and here as well, you know, a new issue. which we are still struggling with to some extent. But we see this trend towards a data-driven economy, and we have to make sure that we adapt our regulatory framework to make sure that financial services providers and insurance companies can benefit from that, whilst respecting, of course, the concerns of consumers. All I can say is that this is actively being looked at in the Commission. It will be a priority for the upcoming Commission, including on the issue of data held by car manufacturers. We want to see what is possible here in terms of greater data availability, but we cannot jump to conclusions yet, and a little bit of patience will be needed on that.
Jean-Laurent and Sonja, your view on this, on the most needed changes or non-changes to Solvency II?
Le point que je voudrais dire, c'est que
the point I want to make is that Solvency II was a major step forward with respect to the management and control risk in financial management, that is financing on a risk-based manner, and with respect to the way we've integrated risk control and risk management in day-to-day management. Now, there's one point in a short-term implementation framework of Solvency II. The second thing is procyclicality. Even though we have to do this disentanglement, quote-unquote, between Solvency II and the rest of the regulations, but today when you want to have the lowest possible capital charge on your assets, you are prompted to invest into what? Into govies, into negative rate government bonds. This has a double impact. Number one, you don't invest in other types of assets, and number two, basically you take assets on the highest possible unprecedented level on our balance sheet as insurers, with a clear prospect of seeing their values go down and depreciations to be booked. So if there's one area to be changed, this procyclicality leads us all to go for assets, and we know with good common sense, and Mr. de la Rosière said so there clearly, at some point when the central bank policy rates are at minus 0.2, minus 0.4, that's a no-go. So it's a fundamental issue for me. And this double phenomenon of lengthening the horizon to be able to engage in a more cautious, prudential approach with respect to risk-taking, and the work done on infrastructure has been positive. And the second factor of solving this procyclicality factor, which has resulted in negative trade-offs, which has defeated the purpose and has countered the interest of the insurance industry. And this is where it links up with the other work on sovereign assets and risk weighting, which are connected with other sorts of political issues, and we won't get an answer on this in the next few months. Did you want to add something?
Maybe add something about more the innovation side, technology, because I think it's will be very challenging for the EU regulators, because on one hand we have to be sure we can uphold with the EU standards to protect consumers. On the other hand, we have to be sure that the industry can develop and use these new ways of working and economical environment to develop and to prosper. And we always have seen, history shows it, that business activities, they do not wait. They never have waited throughout history for regulation. So I think we have to be trying to anticipate, see what's going on around us. And if we see some cities like Tel Aviv, New York, Singapore, where supportive regulative is there to enable the industry to develop, and I think it's a very important part to take up in regulation to see what's broader than the EU is going around.
And if I may, I think it would be interesting to clearly, coming back to the basics, to say that one of the big challenges is to help insurers to protect consumers vis-à-vis risk, vis-à-vis big challenges we see in the world, rather than trying to some extent to protect consumers from any risk coming from insurers. The consumers are not to be protected from the insurers, but to be protected with the insurers vis-à-vis the risk they face. And I think that this is something from time to time we need to bear in mind. And that's why I think the reference to PRIPS was very significant. In France, we say trop d'impôt tue l'impôt. We see with PRIPS that too much information kills the information.
On this statement, maybe I will. Yes, of course. Yeah.
Maybe to your point, you know, there are lots of good intentions always out, and we recognize that. But we have seen with a lot of European measures, I start with LTIF, and I could continue. You know, there's a good idea, but then you come with a supervisory approach that is always erring too much on the side of caution. When you look to other regions of the world, what you see is that in other regions of the world, the supervisor says, we identify this risk, we monitor this risk, and then we see, you know, after a series of time that we have monitored this risk, whether we need actually to react on this risk. In Europe, we always go to the data that you mentioned, and we always see the worst case scenario, and we immediately act on the worst case scenario. And I can swear to you, I mean, you have seen in the 2018 Solvency II review, the interest rate risk, first proposal by EIOPA. I mean, it would have, what, 300 billion extra capital? Now, at the latest proposal, we are between, what, 40 to 70 billion? You can, of course, take an interest rate risk and say, if we go to -3, to -5, to -10, then we are super safe. But then you also are too safe to have the economy working and to have the insurance sector providing the value that we can provide. So I think that is what needs to change. It's the approach that we want to have extra security, a seat belt, and everything around us, and then a speed limit that is 2 instead of 50. That is our problem.
That's, what you spell out there is what we call in France the principe de précaution, to which French people are very attached, in contrast to maybe other countries in Europe. I see your point, but I think the notion that in the financial sector we should wait to see risks materializing before acting upon these risks is something which is a bit dangerous and tricky, especially if you would want to replicate that not only to the insurance sector but also to the banking sector.
No, but
so I think we have to be very cautious here, but I see the point in, you know, supervisors having a lot of influence on the development of the rules, and supervisors, well, they're like everybody, they want to sleep well.
Of course.
And their duty is to focus, of course, on the prudential robustness of the regulatory framework to the detriment maybe of other contributions that the insurance sector should make to the economy. This being said, the rules ultimately are not adopted by the supervisors. They're adopted by the Parliament, of course, and by the finance ministries. And you might expect that the Commission, yes, but also the finance ministry take a broader view, you know, on what insurance insurance companies should do and should not do. But for that, again, I have to come back to the data. You know, we need to be sufficiently sure that, for example, supervisors are on a given point overly conservative, so that we can move away from that and give a bit more leeway to insurance companies. And here the input, the credible input from insurance companies is critical, and I have to say that very often this input is disappointing. If I remember the call for advice that the previous Commissioner for Financial Services launched in order to understand the impact, the combined impact of the various regulatory pieces that we have in Europe on the financial sector, well, the data we got from the financial sector was quite disappointing and did not allow us in a credible manner to significantly alleviate the burden that falls on a number of actors. So we have to work harder to make that happen.
Should we open the floor to a few questions? If you have, please raise your hand and go ahead, please.
I think this is more a comment than a question. You know, we are all preoccupied with Brexit. Personally, I think it's a dreadful mistake. Separating ourselves from one of the big markets is a crazy thing to do, but we are where we are. The question is, how much alignment should there be in future between Britain and the EU in matters of regulation, including financial regulation? There is a worry, I know, widespread in Europe, that Britain will become a Singapore on Thames, a deregulating market, a low tax market. That is not where the financial industry wants us to be. It needs to be very clear, because the benefits of alignment with Europe on a continuing basis are enormous for the financial industry, the insurance industry, and the financial industry in the UK. Now, you can see a risk of divergence. For example, if the review of Solvency II was very harmful to the interests of the life companies in particular in England, but we would not want that to happen. It is important that we travel together in this new existence. And from our side, we will work to that end. So don't let's, I hope, get Brexit out of proportion. It is an opportunity for both sides. We don't want it to be a threat. We want it to be an opportunity.
Do you like to add something to that?
I think that I already commented this topic during what I told. Indeed, I think it has. You have to look at both sides, and I think it will probably also give new opportunities. And I think from the union, we really need to follow that up and see what are the good bits that we indeed can help us to get this diversion again towards the two ways of regulating on both sides of the channel. So I believe indeed that Brexit is what it is. We are not going to change it here in the room. So I think we need to take it the impacts on one side, and I think there are maybe not yet known either what the real impacts are. We have some indications, but on the side, as we don't know what the regulation will become, I think it's an opportunity to see how we can indeed continue to work in a global framework.
Well, one very brief word on that. The answer lies very much in the United Kingdom. I think the UK can choose between aligning itself to the regulatory regime that we have in the EU, in which case it will have access to the single market, or it can decide to depart from the regulatory framework that is established in the EU, providing maybe UK firms with greater competitive advantages, but then with no access to the single market. And that's the trade-off that will need to be assessed mainly in the UK.
Would you like to say something else? So if there are no another question, yes, please.
I understand very well that it's the response of Mr. Merlin, but I'm not totally convinced about the fact that the Commission, due to the fact that she has over the past 3 years got to struggle enormously with that departure, is in the mind to accept that some of the ways that the UK would like to follow are maybe the better ways. And therefore we should keep an open mind to that. And all the more we should keep that open mind due to the fact that otherwise we will become the Castle Europe, seeing that all the markets would be between the US and let's say after the trade wars, which now were initiated by Trump, and China and Asia, we will see that they will work together. And if Europe, seeing some developments there, and the UK is precisely deciding at this moment willing to join that development, if we decide to keep away from that, maybe the train will pass without all the advantages EU can get from that. So I think that we should keep an open mind to also good developments in the UK, even if they are not completely compatible with our view on what Solvency II could be.
We always have an open mind. What we want to avoid is a, race to the bottom in terms of regulatory standards. But if on very specific items we see scope to alleviate the requirements that we have in the EU after a very thorough analysis of the matter, we will of course take our responsibilities. We're not saying that everything is perfect in Solvency II and stay as it is, otherwise we would not be conducting the review which is ongoing.
We have maybe a final question and then we close.
Oui, une question pour le...
I have a question to the regulator as well as to the European Union representative with the review and revision of Solvency II. This will take some time, right? Because any reform of this scale does take time now with the current low interest rate policies. Shouldn't we be accelerating the review and revision of Solvency II more so than in the past? Because if you take the example of the long-term investment measures for infrastructure, we saw how long it took under pressure by operators to ease up on the rules of the Solvency II. Now, in the current context, could we imagine having an expedited procedure for reviewing and revising Solvency II? We hear you and are fully aware of the urgency, but at the same time, we need to do things appropriately, and doing things appropriately takes time. The finalization of the review process is scheduled for the end of 2020, which isn't that far away and which isn't that much in terms of time, given the high degree of complexity of the issues at hand. And we hope that after that, rapid negotiations can go ahead at the Council level and at the Parliament level. Having said that, if we are convinced that more urgent emergency measures are required and necessary, this is something which is possible and which has been done in the past, but we haven't reached that point yet. Right, in this respect, I think we have covered good ground. There are three key messages, long-term, that we have to address the insurance assets and liabilities, which has so the valuation of assets and the impact on balance sheet. This has impact on how to incorporate the community, society and economic factors in the business model. Number two, the shortage of some assets, green assets, long-term safe assets. These are of concern for us at the central bank, and these negative rates, negative yields, negative returns. I would like to thank the panelists for these very lively and enlightening exchanges. Thank you for this.